it's showing up in some form in IT as well. Tushar Pradhan is with us, director at HXGON Partners. Tushar, good afternoon. Good to have you with us here. Thank you very much for your time. Since Reema was explaining what's happening with Wipro, and of course she's kind of put out expectations for IT services, etc. What is your sense? I mean, is it just a trading kind of a move we are seeing pre-earnings? Or as some at the margin have said that maybe H2 perhaps will mark the turnaround, real turnaround, not stock turnaround, but business turnaround?
I don't really know much about the specifics, but I would think that IT has overall been a little bit of an underperformer throughout this blistering period of stock market activity. But I would still think that I mean there is a reason for IT companies to be valued in the right sense, but may not be for the reasons that some of the other companies are being valued. So one of the things that stand out are industrials, say, for example, even the defense companies. I mean, they're standing out and the performance is because of substantial revenue increases, order inflows, which are of an order which we haven't seen before. Now, nothing like that is happening in the IT companies. So essentially, we have these very mature cash flow oriented companies, which are going to grow at a very certain state rate over a period of time. So I think these movements in stock prices, over a day or two, I think it's maybe people are just reading too much into it, or maybe I've just become a little more cynical about these movements in the short term.
IFL today titled their report, valuations have rebounded, but demand has not. So they're still taking a bit of a cautious stance. But I wanted to get your thoughts in on defense before that.
Raksha, thanks a lot for that. Well, hi, Tushar. And good afternoon. Good to see you again. What's your view on some of these defense companies? That's been a solid theme, if you played it and if you got in at the right time. But currently it appears that some of these companies are factoring in, maybe the next 2 or 3 years earnings as well. Your view at current reckoning, for someone is in, they stay invested. But if someone wants to get in fresh, then what would your advice be?
No, I think, generally the stock markets kind of discount future earnings or future possibilities. Now, in this case, I think the market has been fairly efficient in pricing those in those stocks. And definitely there was a surprise because many people did not understand the magnitude of which these orders are likely. Last, we've had, these efforts for these defense companies to start producing domestically. But I think with this huge thrust on import substitution and make in India and the whole defense, most of the market participants were surprised with the stock market movements initially. But now we are getting to the point where we now understand that it is really now based on, solid orders which are likely to follow. Now, there is a gap between where the market discounts it and the actual news come. So the oldest adage in the market is to buy on rumor and sell on news. So typically, this is where we are coming, where the rubber hits the road and we actually see the extent of these orders. I think anyone coming in fresh needs to understand where the valuations are today. What is the expected earnings growth now as a result of these, likely to reflect in the next 2 or 3 years, and then take a call. I think it's very, very important to understand that eventually the stock price is a measure of how many earnings are there in the future. And if these earnings are somewhat which can be modeled, you will get a fair idea of whether you're buying at a good price or not. So I think I would say caveat emptor, especially for people coming in fresh at this time.
Okay, that's the sense on the PSU space, given the huge rally. Tushar, great to have you on the show as always. Let me expand that thought on the market as a whole, because it's been a phenomenal year, right? 2024 so far, 6 months have been great, building on what was a fairly good 2023, and the market continues to move forward in uncharted territory. So, I mean, on a deeper and wider level, really, what are the possible risks, perhaps, that we should consider? Because I think a lot of people are grappling with how to make fresh purchases now. The smallest of dips are getting bought. There's so much of liquidity sloshing around. So is that becoming a bit of a challenge? And how should one sort of consider and wrap their heads around these things?
No, I think some time ago I heard an adage about the traders in the market, where they say brains and a bull market have very less to do with each other. So I think if you're trying to make sense out of what's happening today in the market, maybe there's not much there. But I must say that there are significantly important positives about India which are happening, which I think should make us realize that while we are trying to find out what could go wrong, maybe you're missing about the magnitude of this move. One of the things that has been announced, of course, is the inclusion of the bond indexes for Indian sovereigns. Now, what is that going to do is to bring in a very steady, inflow of money, which is fairly visible into March next year, which is almost guaranteed. On top of that, the kind of interest rate movements which we're expecting in the US does indicate that an interest rate environment which is slightly lower than where it is now is likely to happen in the next 6 months. Now, typically when interest rates globally start to come off, asset markets generally react by moving up. We also have a significant continuation of political, I would say, imperatives in India, which means that whatever we thought about is likely to continue to happen on an industrial and a government spending scale. Now, when you put all of this together, and the fact that, yes, the last 2 years have been good on the basis of very significant earnings growth, could we imagine that earnings growth from here on is also going to be around 15 to 18% for the next 3 years? Now, nobody's really modeled that because it's too far into the future and it's too, I would say, wild to guess that that's likely to happen. But if that happens, I don't think the market is very expensive. So I think it is a matter of, I would say, perspective to say that are earnings going to go down or stay flat from here? If that is the scenario being built, then maybe the market is expensive. But what if we are talking about a sustained earnings momentum, which will take us the next 2 or 3 years to kind of plateau out? What if? Now, that is something which I think most participants at the moment are not really thinking of. There are, of course, models which indicate that earnings growth is going to remain robust for Indian corporates. But for how long? Most of the analysts and the research reports go probably about 6 months or 1 year into the future. They don't go beyond that. But is the market likely to benefit from the fact that these earnings growth numbers are likely to sustain so long? So I would think that investors need to understand that if they've chosen the equity asset class, they are in for the long run. And I think in the long run, even if there is a wobble or a drop in earnings for any of these years, I don't think the overall valuation is startlingly expensive. I think there are pockets of over exuberance, but I think that is likely because of the kind of earnings volume which we're likely to expect in those companies.
So Tushar, so what you're intrinsically saying, if I got that right, is that if you're going to imagine at least 15% sustained earnings growth for the next 3 years, then at a headline level, this market doesn't look that expensive. So let me just ask you a quick follow-up. Which are the sectors where you think we'll get the maximum of this earnings outperformance? Could it be banks? Could it be IT doing a certain turnaround? Will it continue to be these capex companies? So where will the earnings kicker be? And now we're talking a 3-year view.
So I think I have said that before, that we have domestic industrials, because what is going to really fuel this economy going forward? It's largely going to remain domestic-led. So anything which has domestic earnings growth inbuilt into their business models, I think that is something which looks very attractive. I just left out one more point on one of the things which have happened internationally for us, is that the FPIs have been fairly circumspect on India over the last few years, and that's not because they don't like India. It is the fact that the regional funds which have India in them have been very unpopular with domestic investors abroad. So as a result of which, there will be a time where the global investors will also throw in the towel and say, look, we can't ignore India. Let us put money now back in. And I think that is the last vector, which I think over time, in addition to all the domestic fundamental factors, is probably going to remain a very, very large positive going forward. But coming back to your question, I think, in a sense, domestic sectors focused on industrial manufacturing and essentially about capex are likely to remain very interesting sectors, because their jump in earnings is very substantial. And then towards the end of a mature bull market, 2 or 3 years into the future, is I'm sure FMCG consumption and all those sectors which generally try to come at late stage of a bull market will also stage a rally. So I think over time, you've got to be prepared for rotation. And any sector that you identify now is not likely to remain a perpetual favorite. So that's the caveat I will put in.
All right, final question, Tushar, before we let you go. I briefly remember that we discussed telecom. I don't think you were very optimistic on the price increases going through. What's your view on the telecom space? Because most of them have gone ahead and pushed to the price increases, though the stocks already ran up in anticipation. So I wanted your view on that now since the price increases have come about.
Yeah, that's been a surprise for me. And I think in a sense, probably they're a little bit behind the curve already, because as you can understand that India continues to remain one of the lowest, or let's say the cheapest tariffs for telecom anywhere in the world. And counter that with the kind of capital expenditure which is needed to keep up with the advances in telecom infrastructure. So if you're talking about 5G and then 6G and God knows how many Gs later on, that you will need to continually keep putting capital to be able to sustain your earnings going forward. So which is a little bit like a treadmill. So while you'll get in between very large increases in free cash flow, because then the timing is such that you haven't invested so much, but your price increases dramatically increase reported profits. But as soon as these reported profits accrue, you will have another cycle coming up for capital expenditure, which is significant. So they remain somewhat, I would say, operationally leveraged, where something like an aircraft company where after the investment is done and you have significant improvement in occupancy, you certainly make a great upside. But then you need to add more aircraft, and then it continues to roll on like that. So I would think that it is definitely a part of an overall portfolio allocation. But to think that things have changed dramatically for telecom and then just rush in would not be my way of looking at it.
Okay, thank you very much for joining in, Tushar. Some PSUs are moving up. IREDA should come up for your new screens. A massive 4% up move on big volumes. NBCC has seen a sudden spike. And paper stocks, led by JK Paper, continue to move up. So Pudumji Paper has a 16% gain. Andhra Paper is 5% up. West Coast up close to about 8%, while JK Paper is now approaching a 20% gain. We'll get into a break on that note. On the other side, a few BTST calls from our technical experts.